All right, I have 9 o'clock exactly, so we're going to go ahead and get started. We may have people joining a little late. Just a few housekeeping items. We will be monitoring the chat windows, so please feel free to submit your questions through the chat window, through the Q&A, and one of the moderators will be monitoring that. We're going to be covering 3 sections today, and we'll be pretty disciplined on trying to have about 12 minutes of presentation content and about 8 minutes of Q&A for each section, knowing that people are trying to stick to a pretty disciplined 1-hour presentation. And then depending on the volume of questions that we have, we will probably stick around a little bit after the 10 o'clock end time and answer some additional questions there. For anything that we don't have time to address, we will be publishing a Q&A. Aaron, if you want to go to the speaker panel slide. So we've got Erin Vukolich, and she'll be covering the first section of Families First Act payroll provisions. I'll be covering the SBA loan provisions, and then Jake Carter will be covering a lot of the tax and tax provisions that are in the CARES Act. Also down there at the bottom of the slide, you can see a link to our website, jccscpa.com/news. At the conclusion, we will be posting a link to this presentation for viewing on demand. We will also be posting a Q&A document that should capture anything that we don't have time to cover today, and also probably try and fold in some of the major questions that are asked today. So with that, I'm going to turn it over to Erin to get started with the first section.
Just one thing to add on to that, more housekeeping, is that we are recording this, and we'll hopefully have some links out there as long as the conversion to a viewable format works well. So just FYI, we are recording this as well. So today I'm covering the Families First Coronavirus Response Act. This act was passed almost half a month ago now, on March 18th and 19th. It basically was enacted 15 days after that sign-in date. So originally all the documentation had said April 2nd would be the day that the act would be effective. That was moved up to April 1, I believe, just for ease of being at the beginning of the quarter. It affects all employers with fewer than 500 employees, and it will expire on December 31. It creates 2 benefits for employees, and that is the Emergency Paid Sick Leave Act and the Emergency Family and Medical Leave Expansion Act. So we're going to start with the Emergency Paid Sick Leave and then move into the expanded FMLA. Another note about these wages that are paid is that the employer can claim 100% of the wages that were paid out in relation to either of those programs against their federal payroll taxes withheld from the employee and for the taxation of the employer. We'll go through a little example towards the end where you can see how that may affect you as an employer and how it will affect your employees. In general, employers are required to provide 10 days of paid sick leave and 10 weeks of paid family or medical leave, with that expanded FMLA being a total of 12 weeks, 12-week program with the first 2 weeks unpaid. So first, we'll talk about the emergency paid sick leave. This covers all employees, whether they're part-time, seasonal, full-time. It's going to cover everyone. And it, like I said before, all employers with fewer than 500 employees are required to pay this benefit out. The amount of leave depends on the work schedule of the employee. Full-time employees pay 80 hours, calculated at their regular rate of pay or minimum wage. We also have a calculation of how we determine the payouts, because there are different caps on that. Part-time employees are paid for their average hours worked over a 2-week period, If you have a newer employee or schedules are shifting, you have a variable schedule, it's the average number of hours that they've worked per day over the previous 6 months. If the employee has not worked that long, then you would look at the average number of hours that the employee was scheduled for originally. So we have 6 different reasons for being gone from work, the covered reasons for leave. The first one is the employee is subject to a federal, state, or local quarantine related to COVID-19. Second one is the employee has been advised by a healthcare provider to self-quarantine. And the third one is the employee is experiencing symptoms of COVID-19. All 3 of those will pay out at the full employee's regular rate of pay, capping out at $511 per day, and aggregated over the 2 weeks would be maxed out at $5,110. The second 3 reasons for leave are mostly what we expect to see more frequently. The first one is the employee's caring for an individual who's subject to a quarantine or isolation order. The employee's caring for a son or daughter due to school closures, childcare closures, anything like that where the provider is not available. And then the last one is that the employee is experiencing similar symptoms to COVID-19 or other conditions related to the Secretary of Health and Human Services statements. And those reasons are paid out at 2/3 of the employee's rate of pay, and they are capped out at $200 per day and aggregated $2,000 for the whole emergency paid sick leave. We will go into a little bit of discussion regarding that first reason for leave towards our Q&A section, because I know it's kind of top of mind for quite a few people. Following the emergency paid sick leave is the expanded FMLA. The employees that are eligible are employees who have been at the employer for at least 30 calendar days based on their hire date. So it's not how many working days they've had, it's strictly a hire date look back. The covered employers are, again, all employers with under 500 employees, and the amount of leave is 12 weeks, with the first 2 weeks being unpaid. However, we expect most people to use other means of sick pay during those 2 weeks, whether it's the emergency paid sick leave or other accrued benefits they may have at their workplace. The expanded FMLA also includes some reinstatement rights for that employee's position when they come back. The expanded FMLA is only eligible for employees that are staying home due to caring for a son or daughter due to school closures, childcare closures, childcare provider unavailability, and it is paid out at 2/3 of the rate of pay and capped out at $200 per day or $10,000 in the aggregate 10 weeks of pay. So that's kind of our emergency paid sick leave, emergency expanded FMLA, and then we also have some information about the unemployment insurance. Right now in Montana, if the employee is filing for unemployment in relation to COVID-19, the 1 week waiting period has been waived and the claim will have no effect on the employer's UI rate going forward into the future. So if you are laying staff off, don't worry, this won't affect your UI rate going down the line. You just want to make sure that your employees are mentioning that they are filing a claim in relation to a COVID-19 event. That will indicate to the UI department that they are part of this subsect of people claiming UI, not regular, so it doesn't affect your UI rate. There's also the federal pandemic unemployment compensation, and this one is part of the CARES Act that was issued, which Tony and Jake will go into a little bit more. But it is an additional $600 per week for individuals with claims related to COVID-19. The states can choose how they pay this out, whether they pay it out as one check a week, or whether they pay it with all of the other state UI benefits that they get. per week. It's up to the state to choose. Originally, we expected to see the amounts in approximately 2 to 3 weeks. Sounds like that's actually been pushed back to 3 to 4 weeks now. We aren't exactly sure how we're going to see this happen yet. I imagine we'll get some more information from the Montana UI department once they actually start receiving the funds from the federal government. But right now we're kind of in limbo a little bit on that federal pandemic unemployment compensation. So the biggest question right now that we seem to be getting is, does Governor Steve Bullock's directive count towards qualified reason number 1 on the emergency paid sick leave? And that qualified reason is the reason for being under a federal, state, or local quarantine or isolation order. Right now, based on our research and different statements made by the DOL, worksite closures due to lack of work or the requirement to close pursuant to a federal, state, or local directive do not count as a reason to request leave. We did some research into the statement that was made by Governor Steve Bullock, and it is listed as a directive. It's not a quarantine or isolation order, which are usually used when there has been exposure or suspected exposure. So typically it's not a blanket statement. It is an individual specific item. We're definitely staying on top of this to see if we get more information. Maybe the DOL will give some more guidance on that. I've included a link there that takes you directly to the DOL's question and answer website, and you can look at questions number 23 and 24, and they directly talk about the worksite closures and whether they qualify. So as we hear more, we'll definitely keep everyone updated, but that is our stance right now. And so now that's about it for the Families First Coronavirus Response Act. Now we can hit some questions.
We got a lot of good questions coming in, Erin. The one I think that would be most applicable to you, because a lot of questions are coming in that I think Tony you're going to touch on, as well as myself here in a little bit. Let's see here. I saw one. Sorry. Erin, what can you tell us if people are using a staffing agency? How would any of this apply?
So there is, like, they're using a PPO or a PEO. There is some specific guidance in the questions on the DOL website regarding that. I don't have anything in this about those, but there are specific answers. So we will pull those down and include those in the kind of follow-up that we send, because there are specific examples on that. I'll make sure to write that down so we include it. One thing to note, one other question we are getting frequently is intermittent emergency paid sick leave or expanded FMLA. You definitely can have employees who need to take intermittent. If it's a 2-parent household and one parent stays at home with a child, and the other one's working from home, they may flip-flop. It's all about communication with the employee and the employer, making sure you're talking about that. If they want to work, 1 day a week on site, if we can, once the stay-at-home order is removed, they can definitely do that and still get paid for the expanded FMLA. Definitely intermittent is allowed. They just really recommend, the DOL recommends having some really open conversation to make sure that everyone's doing what they need, having all the right resources for everyone, and making sure that communication line is open. I was going to talk about an example of the federal refund or reimbursement of those wages. So as an example, if you paid any number of employees, we'll say you pay $1,000 in the emergency paid sick leave wages out to an employee who had to stay home, or multiple employees who had to stay home to take care of children. You will then have your 941 liability that normally has to be paid to the IRS through EFTPS, or if you make it automatically as part of your payroll system, usually that's made somewhere. Now, if your liability was $500 for your payroll, for the employees, Social Security, Medicare, federal income tax, and the employer's portion, you would be able to offset that $1,000 that you paid with that $500 liability. So in the end, you would only remit $500 to the federal government, and you get to keep that other $500 because you paid out $1,000 in the expanded or the emergency paid sick leave. So and then you get that other $500 refunded to you, reimbursed to you at some point. We expect to see it with the quarter two 941 filings. There isn't an example yet of what those will look like, but that's when we expect to see whatever remainder you're still owed as the employer. That's when we expect to see that you would get it. So it's important to remember that this is not, you aren't out this money. You might be at the very beginning with what you pay out to your employees, but you will be refunded or reimbursed that money by the IRS through either a reduction in your 941 payments or a refund check. So something to keep in mind there.
Erin, does the FMLA apply to businesses who don't currently offer sick leave or PTO?
Yes, these apply to any employers with fewer than 500 employees, whether you have an accruable benefits, PTO, vacation sick, whether you have that policy or not.
Can employees claim UI benefits and have the employer do the emergency paid sick leave at the same time?
They cannot.
Okay.
Doing the emergency paid sick leave or expanded FMLA precludes them from filing for UI. And even if they did go in and file a UI claim, the unemployment insurance department's going to send a request form to the employer to fill out. And that's when the employer would say, hey, I don't think they should be eligible. We're still paying them under these different programs, whether it's the emergency paid sick leave or expanded FMLA.
Several questions are asking, we've got existing benefits. How does the existing sick leave kind of interplay? Does it count towards someone else's already accrued time, or how does it work with other benefits?
So the one thing you can't do as an employer is you can't require that someone use their other benefits before using either of these ones. It doesn't take the place of those other benefits. It is strictly adding on to whatever policy you have. But there is a time frame on this. So they can't take emergency paid sick leave after 12/31 of 2020. You can talk to them if they want to take some of their other sick leave first and then the emergency paid sick leave. You can definitely do that. You can't require that as an employer though. So it's definitely in addition to what you may already have in place.
Gotcha. Just scrolling through a couple other questions here.
Aaron, I'm just going to ask a clarification on unemployment. Could you address part-time employees who are maybe extremely part-time and from the access to unemployment and also the federal $600?
So we have not seen, or at least I have not seen, how they might prorate that for very part-time employees. It's something that we actually got a question on this yesterday. So it's in my to research kind of folder that I have right now, my list of questions to research. They can definitely file for unemployment. When people get unemployment, it is a percentage of their taxable wage base that they've had reported for the time that they've been working. And it may not be directly for one employer. They may have worked for several employees over the last 4 quarters or several employers over the last 4 quarters. So it may not be just your wages as the employer that they're looking at. They take a percentage of that taxable wage base and pay it out. And then whether the employee is going to get the full $600 or not, we're waiting to see. Like I said, that's one of the things that I need to research. I didn't see anything just at the surface about prorating. I wouldn't be surprised if they do it, but there wasn't any like this will be prorated for part-time employees. So still need to do a little bit of research on that. And that is $600 a week added on.
Okay, so we got time for one more question. We got to get to Tony's section. So Aaron, 60 seconds. This question, I think, will kind of answer maybe a couple of people's questions. In general, when people are going to be filing for unemployment, I think employers right away might be thinking that's going to affect their rate. A question came in for unemployment, so their future unemployment rate. So talk about that. And then someone also asked, what if someone filed for unemployment kind of before the whole pandemic hit us? How are they, is that going to affect kind of their employee retention? Do we know yet? So I guess just talk about how that's going to work during this time.
So the unemployment, as long as the employee states that the unemployment was due to COVID-19, it won't affect their UI rate. And the employee can go back if they didn't tell the unemployment insurance department that that was the reason 2 weeks ago that they filed. They can go back and say, hey, I just found out I needed to tell you this was in relation to that. And they should go back and retro it. If they don't, I would say talk to whoever does your filings for UI5. I know we have a person at the UI department that we talk to pretty frequently about this kind of stuff. So I would talk to someone there. So I think you can definitely make sure that any people that have been on unemployment for the last month or so since this COVID-19 stuff has happened, you can make sure that it definitely doesn't affect your UI rate. As far as people filing before the pandemic, that is my understanding that it will affect your UI rate because them claiming UI was not specifically tied to this event.
Sure.
At least that's my understanding of it.
Great. And a lot of questions coming in on the PPP EIDL. So I think we're swinging over to Tony.
Yeah, great. So I see there are a lot of questions on Aaron's section, and just want to reaffirm that we're going to copy all those down, and we'll be working diligently to answer those questions and get something posted. A lot of repeat questions, so we'll synthesize those and get those going. But moving on to the Paycheck Protection Loans, the PPP, that was enacted under the CARES Act, March 27th, 2020. Just in general, it allows small businesses with fewer than 500 employees to access an SBA loan to cover costs between February 15th, 2020 and June 30th, 2020. The loan is very strictly formula-based. It is based on your average monthly payroll costs for the 1 year preceding that date, preceding the date of the loan in general, and we'll kind of get to that on future slides here. So I'm going to move on to the eligibility on the next slide. A little bit more specifics here. As I mentioned, small businesses with fewer than 500 employees, or they meet the SBA size standard. So the Act sets aside that 500 limit for certain industries such as hospitality, and you can find that out on the SBA website. They have a SBA size standard tool on the SBA website there. 501c3 organizations with fewer than 500 employees. A lot of questions here. The PPP is not accessible to 501c4, 501c6, or a lot of other nonprofit organizations. There is some other provisions, but just not the PPP. This loan is also accessible to sole proprietors, independent contractors, self-employed individuals who carry on a regular business, captures those gig employees, gig work employees. Also two other special categories, tribal businesses and 50C19 veteran organizations that also meet the SBA size standard. Moving on to the application process. Currently, the application for small businesses is out. The application for sole proprietors and independent contractors is not online yet. Expect that to look differently. The application for those folks is delayed an additional 7 days and only available on April 10th. Technically, the SBA, the application is live today on April 3rd. However, we've seen banks are not ready yet. You can access the application on the SBA's website, but again, banks are pushing back a little bit and they'll be delayed getting their processes in place because they're still receiving updated guidance from the Treasury on how to issue these loans. So all loans on the PPP are issued directly through an SBA approved lender. If you're not certain that your bank is an SBA approved lender, just call them and ask them. And businesses will need to support whatever payroll calculation. Again, it's a very simplified application process. It's based on a multiplier of your payroll costs, but those costs will need to be supported. And then, of course, the application will need to just answer a few eligibility questions. Very simple. Moving down through the payroll calculations in a little bit more depth, the average monthly payroll is defined as the monthly payroll from 2019 or 1 year preceding. There's a little bit of mixed guidance on, what this 1 year period is. They're saying that those costs need to be supported by IRS documents. So some banks are pointing towards a calendar year 2019, so they can look at W-2, W-3. The language does stipulate 1 year preceding the date of the loan, so we might be looking at Q1 of 2020 plus the last 3 quarters of 2019 to get to that annualized number. Seasonal businesses have a little bit different option. They can elect for the covered period of 2019 that mirrors the covered period in 2020. So February 15th through June 30th. And then new businesses can elect to use the 2-month period in 2020 if they don't have that history. Let's move down to what are included in payroll costs. Your typical salary, wages, commissions, anything paid to an employee, cash tips, vacation, and other similar leave benefits, employee separation allowances that may have been paid in 2019, health insurance, retirement benefits, and then state and local taxes assessed on wages. Missing from this list notably are federal taxes. Those are not considered payroll costs for the calculation of the PPP loan. On the sole proprietor independent contractor side, we're going to be looking for some additional guidance coming out on that, and I think that'll come out when the application and the borrower instructions are issued by the Treasury. But we're going to be looking at some other form of official documentation to establish any wage, commission, net earnings from self-employment that those individuals have generated, and that's going to be on a net basis. We think it's going to be on a net basis, and we'll be looking at a cap of about $100,000 for those individuals.
To clarify on that section, Tony, a lot of questions just on people asking about their self-employed independent contractors, how this applies to them. So can you reaffirm and repeat that last section you said right there? Just to make sure.
Absolutely. So this loan is available to sole proprietors, independent contractors, and self-employed individuals. The application date is not available until April 10th. It's delayed 1 week from small businesses. There will be additional borrower guidelines coming out. Those will be published on the Treasury website or the SBA website, and they will give guidelines of what you need to provide to the bank to substantiate what your income is for the previous year.
Great. Thanks, Tony.
Okay, all right. So some exclusions from the payroll calculation. On a per individual, per employee basis, compensation is capped at $100,000. That includes benefits as well as just straight wages. So if you have health insurance or other benefits, retirement benefits that you're paying as an employer on top of that, you would need to consider that in the full $100,000. I mentioned payroll taxes already, so those are federal taxes, and income taxes. Those are not included in the payroll calculation. Any compensation paid to someone primarily residing outside of the U.S., and then also any of the sick leave or family medical leave under Section 7001 and 7003 of the Families First Act. Those are also excluded if you're going to be claiming a credit for those.
Tony, just a clarification on that one. I know we get a lot of questions on whether they choose one or the other. Do they do the Families First Coronavirus Response Act or the Paycheck Protection Loan? And they are two separate items. As an employer with less than or fewer than 500 employees, you're required to provide the other benefit. You just can't use those wages paid under that benefit to qualify for this loan or any of the forgiveness for it.
Yep. Good. Thank you. So we're going to move on to the forgiveness portion. So a portion of the PPP loan is eligible to be forgiven tax-free. And I do want to clarify that that is a tax-free forgiveness. There's been quite a few questions coming in on that. The amount of the forgiveness is the sum of payments made for eligible costs during the initial 8-week period beginning on the loan date. So eligible costs are payroll and payroll-related costs, similar to the ones that were listed in qualifying for the loan. I've got listed mortgage interest, and I'll expand on that a little bit. The Act uses the word interest on other loans very generically, but the borrower instructions specifically list mortgage interest. So we expect some additional guidance to clarify. So if we've got an equipment loan, does the interest on that qualify, or is it just real property-based mortgage interest? Rents qualify. That would include self-rentals. So if you are renting, if you've got an S corporation that has the real property and you're renting to yourself, that rent would qualify, is our understanding. We would expect that the bank's going to require a lease agreement. So duly executed lease agreement would probably be necessary to substantiate those costs when it comes time to apply for the forgiveness. And then certain utility payments. Certain utility payments is the language used, but it's pretty much all the traditional utility payments that you would expect in a regular business. Moving down to just kind of a simple calculation on the forgiveness. So the forgiveness does have a reduction if you reduce your staff from an FTE perspective or have a greater than 25% reduction in the wages that you pay to the employees as compared to the previous year. So there's a couple of very simple calculations there. Again, the forgiveness includes the payroll costs plus some of those non-payroll costs. So let's take that first example where we're reducing our FTEs down to 9.2. So the forgiveness on the payroll costs is going to be $92,000. Let's say we had utility costs of $10,000 paid during the period. So our forgiveness would be $102,000. So it's going to be your payroll costs plus your hard costs. The borrower instructions are indicating that the percentage of the non-payroll costs that will be allowed to be forgiven is going to be capped at about 95 or at 25% because they're expecting this to be highly utilized. Really quickly, going to go through a couple other provisions. Employers can bring back employees that were previously laid off. I know this is a big question because employers have furloughed employees because of lack of resources. The Paycheck Protection Loan is designed to be able to restore your workforce. And if you're able to restore your workforce from an FTE perspective and payroll cost perspective by June 30th, you would not have a reduction in the forgiveness that you're allowed. Receipt of the PPP does restrict the employer's ability to claim the payroll tax credit. I believe Jake's going to touch base on that. Double dipping is strictly prohibited. We'll touch briefly on the EIDL next. The EIDL is available for payroll costs, but if you apply for both, you are eligible to apply for both, but if you apply for both, the EIDL has to be for something other than those costs that were covered by the PPP loan. Repayment, the Act calls for the repayment period not to exceed 10 years and not to exceed 4% interest. The guidance that is out right now is they have indicated that the payback is going to be 2 years at 1% interest. So definitely something to consider if you opt to roll in an EIDL loan into your PPP loan. Make sure that that 2-year payback fits with your circumstances. Under the PPP, your payments are deferred automatically for a 6-month period. And if you use those funds for an allowable use, allowable purpose, but you don't spend the entire amount, any unpaid portion, unforgiven portion is non-recourse against the borrower. All right, I'm going to move through EIDL real quick. So EIDL allows for all businesses to apply directly through the SBA. They can check the box for the $10,000 advance on the loan. That's the emergency grant. Those funds must be used for the specified cost as defined in the application. The list of those are basically business related, payroll costs as such, and that grant would not be required to be repaid even if the applicant is subsequently denied the EIDL loan. Again, I want to just reaffirm that you are eligible as a business to apply for both the EIDL and the PPP. You can roll an EIDL into your PPP if you so choose, or you can leave them standalone. So in the interest of time, why don't we hit a few questions?
There are some good ones, Tony. And I can't keep up, but I've got a really good list here. Workers' comp, does that come into play when you're calculating your PPP number for wages?
I believe it does. So it's not federal. So workers' comp is state. So I believe it would be counted in your payroll costs. Certainly state unemployment is.
Single member S Corp owners, are they looking at the self-employed rules, or would they be looking at the PPP rules and be treated as if they're the one and only employee, they'd be going after this PPP loan, correct?
Yeah, so they should probably visit with their CPA to optimize, what course of action is best for them. Do they do both or one or the other, or do they combine them? But certainly that single employee, single member S Corp, they would be eligible for the PPP. It would be limited to the compensation that they're paying themselves. So if they've artificially set their compensation very low, they obviously wouldn't have access to much relief through the PPP. So that's where they may want to consider something combined with the EIDL.
I'm paying 1099 contractors. Maybe it's a blend, and maybe all I do is pay 1099 contractors. How does that work with this PPP? Or do I count those people as a type of wage? Or
very popular question. The answer is no, because the independent contractor is able to access the PPP themselves to replace what they would have been paid from the business. So if you are a business that you only pay subcontractors and independent contractors, your option would be to look at the EIDL, and you would not be eligible for the PPP if you don't have any payroll costs.
What can we talk about guaranteed payments? Are those included in this calculation? So I'm assuming we'd have a partnership here. Maybe husband, wife, we don't know, but regardless, with the guaranteed payments, because they are subjected to self-employment tax, how does that work?
I haven't seen any guidance specifically on guaranteed payments, so probably need to put that on a research item. Guaranteed payments, I will say, is not listed in any of the guidance that I've seen as compensation.
Yeah, good, because that was the answer in the back of my head too, so that was a good answer. Owner's draws. So, we have an owner, maybe an S Corp owner pulling a salary, but then there's also, the idea of draws. There's the bottom flow through income line item. how does that factor in? Does it?
Well, it's not going to factor into the PPP loan, but again, this is where the business may want to combine a PPP and an EIDL and substantiate an economic hardship where they've lost revenue. So if they have a needs-based, their revenue is going to decrease, so they can substantiate a need for an EIDL. So they may be able to replace what they're missing in draws through that.
Great. And then I've got time for one or two more questions.
Jake, let me
questions.
Can I just back up?
Yeah.
So the EIDL must be used for approved purposes. So they can't make draws to themselves with the EIDL.
Sure. Let's a lot of questions, or hopefully this will address a lot of different questions in regards to that $100,000 cap. So can we just talk about that? Are we capping just the wages, and then the UI and certain things can go above and beyond that, such as the benefits, or how does that work? And let's reiterate that which taxes are not to be included in there. I've got questions coming in about prorating FICA and Medicare. So I think let's hit that one home before we go to the next step.
Okay. So the items that were listed, and we can put out in the Q&A specifically what's allowed, but any tax that's federally based, whether income or payroll, is not counted. Anything that is state-based that is applied to wages is counted. It is in the aggregate, so you take all your vacation, sick, retirement benefits, health insurance benefits, and compensation paid. That's your compensation package. If that exceeds $100,000, it is limited to $100,000.
Great. And then a final question on the EIDL. And I think this is a very applicable question. What can you tell us about people who have rental properties? The rental, more passive type of income. We're going to see a lot of people, a lot of tenants possibly not being able to afford rent. So what relief is out there for those people?
Yeah. So again, the EIDL would be accessible to any active trade or business, which includes rentals. So if you've got a fourplex or an apartment complex or self-rental of some type, you would be eligible to access the EIDL, apply for that $10,000. You check the box for the emergency grant. And then whether you're approved or not would be kind of a needs-based evaluation with the SBA, but rentals would definitely be able to access the $10,000 with EIDL.
Great. And I just a general comment, I think, to all of our viewers too. I see a lot of maybe assumptions being made that when I get this money and I think it's really important to note that this is a loan, the PPP specifically, as well as the EIDL. I mean, the EIDL, they are loans. And relief is going to have to be applied for. I know Tony has said that throughout the whole time there, but it's kind of going to be I interpret it as a two-step process. The government's trying to push the money out, but and that's all fine and well. And I think it's just mindful that all the employers and everybody here needs to be aware that the documentation, even though there is no guidance on what documentation yet for proof of the forgiveness is quite clear yet, is going to be coming. And so I think it's just important that it's going to be the next phase of actually having that debt forgiven, that loan forgiven, is going to be a task in itself. So just really important. Any other comments on that, Tony? Or
no, I think if businesses stay on point, the PPP is designed to keep your workforce at the same size as it was in 2019. So get a paycheck to your employees, whether they're working for you or not, whether there's stuff for them to do. That's what the PPP is designed for. The EIDL is a needs-based loan to help businesses survive and pay their normal business expenses. So if you stay on point and you use the proceeds in that manner, you're going to be fine with the forgiveness provisions and the repayment provisions.
Yeah. Great. So as I'll take it from here. I think just an overview of kind of how Aaron started talking about the FMLA and qualified leave. deductions there. Because everyone's asking us, which one do we choose? Which one do we choose? And it's important to know there's kind of a hierarchy. I would say how Aaron started. If people can qualify for those FMLA kind of emergency leave paid wages, that's kind of a good start. The concept of double dipping, there is no optimization of double dipping. They're very clear on either certain credits or forgiveness loans or the EIDL. Some can work in harmony, some cannot. So there's no strategy out there of trying to do both simultaneously on the same wage. But there are strategies, I think, to do maybe the EIDL and the PPP if you're able to qualify for those. So really, then it's kind of you're weighing whether you can qualify. I think for the PPP, I think a lot of scenarios we've been running, Aaron, Tony, myself, the PPP seems to be winning most of the times if people can qualify. And then it's kind of a toss up between the EIDL, what I'm about to talk on next, and that's the employer retention credit. So on the next slide is kind of that general overview of the employee retention credit. Very ironically, the IRS likes to name credits in certain ways. Very interestingly here, there is no real retention qualifier. I think the intent of this credit is to retain your employees, but if we look into the details, there's no real qualifier for number of employees having stayed, having gone, which is very ironic, but just something to note. This is a fully refundable tax credit, up to 50% of the qualifying wages, which I'll talk about. And it's the wages that are paid from March 13th through December 31st of this year. So it's a very specific time frame, and it's limited to the first $10,000 of wages per employee. So you're looking at, if you qualify, it's up to $10,000 of wages per employee, so a $5,000 max per employee. And so I guess we first need to determine if you are an eligible employer. I think a lot of people will qualify for this. The first qualifier is operations must have been fully or partially suspended due to an order from a government. I think a lot of people on this webinar are probably Montana based. So if your business was affected, essentially whether you were fully closed, let's say you were a bar or restaurant, or let's say you were just any sort of any sort of place where there's gatherings of people or something. Governor Bullock's declare of sheltering in place. If your business was affected by that, fully or partially, you would qualify. And then if you're not, if you're just if you're a business that could technically stay open, there's been no direct order to you, then there's a gross receipts test that if you experience a quote significant decline in gross receipts, I'll go into a calculation in that soon, you would qualify as well. So if we can get you qualified, then there is a credit available to you. It's going to be filed on your quarterly form 941. The whole idea is rather than a lot of credits are sometimes based around your tax return. So rather than wait until the spring of 2021, the government has tried to push this out quicker. So they're doing it on the payroll forms. So someone filing their 941 or even potentially sooner, I'll get into that, could see this credit hit home right away. So the credit is reconciled in your 941. The intent is to reduce the amount due on the 941, and any excess would actually be refunded directly to the employer. And then on the next slide, we can see that for accelerated payers, there is a special calculation. If you're able to do the calculation kind of on the fly or with the help with your CPA, if you were to, let's say this Friday, determine you have a credit due to you and you owe $5,000 on your accelerated EFTPS payment, and you think your credit's $4,000, you really actually only need to remit $1,000. You're instantly seeing the benefit of that credit. Again, we got to make sure that number is calculated correctly, but that's the whole intent of this credit, is to try to for you to see that right away. For those who need the money even faster and maybe aren't accelerated, there is a new form out there, Form 7200. I won't go into that too much detail, but there is a form out there for this. A couple of no's, a couple of yeses. It's not available to self-employed individuals. So all of our Schedule C filers, unfortunately, cannot take advantage of this. And it's not available to employers who receive the PPP, the payroll, the Paycheck Protection Program loans. So you cannot do this credit in conjunction with the loans that you receive from the PPP. You can claim this in conjunction with the qualified leave wages that Aaron had talked about. But again, you cannot do it on those same wages. So there is that hierarchy there. Get the deduction for those wages paid. And then you can, once those got to get kind of pushed out of the way, and then you can go after this credit. If you're an employer with over 100 full-time employees, there is kind of a squirrely calculation you have to make. I won't go into that here, but just be aware if you are a large employer over 100 employees, it's not quite as simple as just doing the math. And that math here is on the next page. I just have there's a lot of numbers here, I apologize. But in essence, what you're looking at is a comparison of your 2020 receipts, your gross income, gross sales, over your 2019 of that same period. So the only change in these two, there's technically two graphs there. Q2 of each of those scenarios changed, and I did that just simply to show what happens when there is a change. So in essence, this is going back to whether you have seen a significant decline in gross receipts in order to qualify. If you're not a business that had an order that said that people weren't allowed to shop in your store, but you just had a serious decline and decided to shelter in place. If you had a significant decline in gross receipts, and in order to qualify, essentially the trigger is that you need to fall below 50% of your gross receipts in the 2020 quarter as compared to the 2019 quarter. So in my example, Q1 of 2019 was $210,000 of sales. Q1 of 2020 was $100,000. They fell below at 48%. That triggers the credit. They can qualify. And then you qualify for every quarter thereafter until you go over the 80% mark. Once you go over the 80% mark, they are deeming you having more or less rebounded, and then you qualify still for that quarter, but then the next quarter, the credit's not allowed. So in my first example, they qualify in Q1 and Q2, but then because they rebounded in Q2, then they don't qualify in Q3 or Q4. However, in my second example, they stayed below that 80% mark, so they could qualify for Q1, Q2. They rebounded in 3, they can get the credit in Q3, but then Q4, they're out. This is only a 2020 tax credit. So, if someone were to stay below 50% the entire way, they would qualify for all 4 quarters. This isn't just, these are just some examples that we ran here. So get with your accountant, do that calculation to make sure you do qualify, assuming you're going after this employee retention credit, right? Because you got the PPP, you got the EIDL, and then you got this. Okay, let's go to the next slide, Aaron. So that's essentially kind of the big, I think we talked about the big 3, big 4 items that are out there. I'm going to talk about I'll try to run through a couple of these, just because they're out in the media. And if anybody has questions, we'll try to follow up, on these. There is a new provision out there for the delay of a payment of payroll tax. To be clear, this is just the employer portion of the Social Security tax. So it's not everything. If you're paying in $5,000 for the on your 941, it's not the whole thing. People are thinking it's the whole thing. It's not. It's just the 6.2% portion of Social Security, which is the employer's portion. The whole idea behind this is just simply to help with cash flow, right? There's no credit here. There's no forgiveness here. This is just simply kicking the can on an expense that doesn't affect your employees. It's yours. It's your technical burden, and it would just help with the cash flow. In essence, it's for wages paid between March 27 through December 31 of this year. And let's say the total amount of that 6.2% came to $10,000 in total. you have until December 31 of 2021 to pay half of that, so $5,000, and then the remainder $5,000 would have to be due by the following year of 2022. Consider this a tax-free loan if you want. That's really what it is. It's just it's a vehicle to try to help retain money in the business as long as possible, if needed. How we report this, track it, to be determined, but just something to be mindful that it is out there. All employers qualify, regardless of size. So I could see some large employers taking advantage of this. It can be done. It's not available to employers who receive SBA loans. So if you do qualify for the forgiveness of those PPPs, then you would not qualify for everyone else. Even self-employed individuals do qualify for this. So our Schedule C filers could, in theory, kick that can if they need to. The next topic we will talk about is very quickly, there's been some modifications to the net operating losses. Essentially, there's some retroactive piece to it. 18, 19, and 20 net operating losses now can be carried back under the TCJA. They were basically the carryback was pushed out. Now it's back. So just something to be mindful there. If you are seeing a significant tax loss, you now could carry this back into a year where you made money and apply for a refund to help offset those. Get with your accountant on that one. That could be very significant for some people. And I think this is just a list. I'll let people, we'll make either slides available or we'll post this on our website so people can see this. The last thing I want to talk about, Aaron, is on the next slide. This truly is applying to absolutely everybody out there. I think everyone's probably read an article or 10 on this on this item, and these are the stimulus checks. Soon to be coming. Our Treasury has promised that they're going to be coming out soon. I've heard the week of April 13th, April 14th, they're attempting to start sending those out. We will see. Hopefully you have your direct deposit information online. That's the best way to get it. They are supposedly going to be setting stuff up on irs.gov to allow you to put your bank info in, possibly to file a quote simple return if you don't have a return on file. But just quick recap, it is a $1,200 check per eligible individual, as well as $500 for each qualifying child. There are some special rules around that. There are some adjusted gross income limitations. So if you are over those, your check could be reduced to as little as $0. They will be looking at 2019 tax return numbers. If your 19 return is not on file, you're on extension, or just haven't filed yet because we have a July 15 deadline, they will look at your 18. And I won't go into too much if your 18 is better or worse than your 19, what they're going to look at. But supposedly whatever's on file is what they're going to use. So do with that as you will. And then once we get those checks, they're going to follow it up with a letter, I guess, make sure we got the money. So don't be alarmed if you get IRS mail for the first time. They will be sending out letters. So let's say you're someone got their check, you didn't. Why? The IRS will hopefully send letters to make sure that they connect with you. And I think at that point, there's a couple other items, but I think a lot of people are really geared towards maybe more the business end of things. So I think we should, again, we'll have a lot of this information on our website. So please look to that to get more of this information. Are there any questions that I can answer, Aaron or Tony, that you think came in that are applicable?
Yeah, I've got a couple here, Jake, that are good. Is the ERC on a cash or accrual basis?
Oh, well, I'm going to say cash, because they are looking at wages paid during a specific time frame. So I would think that would probably only hurt if, come the end of the year, you've got your paycheck that hits January 1, 2021, perhaps. And I would say, it could be a blend then, because I think they're trying to capture those year-end wages paid. So there's not enough guidance on that, but I would say that the credit is primarily going to be hitting people in Q1, Q2, Q3. I think we'll have to tackle that Q4 question when it comes.
Okay, so we'll look for guidance on that then.
Yeah.
Another one on the retention credit. Does being closed down to a state order make you automatically eligible, or do you have to have a reduction in quarterly revenue?
It makes you eligible. It makes you eligible. If you were shut down, that is one of the qualifiers. It's kind of conversely to what Aaron had said earlier about Bullock's comment in the UI world. This one is very, very clear that a fully or partial closure of your business qualifies you for this credit, I think. And this is more of an IR. This is a federal credit. So they're very clear that a governor's orders to shut you down, or even partially, a restaurant that goes from in dining and takeout to takeout qualifies. That qualifies.
Great. That was the next question was if you've got multiple departments such as pools, lodging, restaurant, bar, and only one or two were technically required to shut down.
Absolutely. That qualifies. Yes. And so now, fortunately, I think the most concern I'm getting from people is, Jake, which one do we need to choose? We got to get on this now. And the PPP, there's $349 billion and we're just one little area, right? There's a lot of other people out there and that money's going to go fast. And I think the banks are slowing their roll a little bit. So I think we got a little time here, but if that money goes, I think the next thing is EIDLs and looking at this credit. I think this credit could be a saving grace for some people for sure. Great.
And I know there's a lot of people who are probably thinking about their parents or grandparents a little bit. So I'll just kind of make a comment. There was one question regarding the checks that are becoming, and there was initially some comment that those people who are on Social Security alone would need to file some type of a return. And I actually did see some guidance this morning that said that those people who have filed returns, those will be in the first group of people getting checks. Then they're going to go to get people who just get SSI. So they'll go back to those folks who are just getting SSI and they'll get checks.
That's right, Tony. Just to touch that really quickly, the concern was that those folks sometimes didn't need to file a return. And the IRS came out and said, you better have your returns filed. And then they finally realized, oh goodness, okay, we can't have everyone do that, especially with what we're going through. So essentially what they're doing is they're looking at the Social Security Administration, what they've got reported to the IRS, because they're reporting that information to the IRS. And so they're looking at that as well as our railroaders. They should be covered as well.
Yeah. One last question, clarification on the rebates as well. If you have a college student over age 17 and you claim them on your tax return, they will not be getting a check.
Yeah, that one sucks. Sorry my language. That one's a bummer. Don't laugh, Aaron. Those people can't catch a break. They everything just thrown out for them. So I'm really sorry to hear that. Yes, you have to be under the age of 17. Our interpretation is as of 2019, even though it's a 2020 stimulus credit. But just to clarify, if you claim them and they're over 16, so they're 17 or older, you won't get the check. For the $500, you'll still get if you're in the AGI limitations, mom and or dad can still get those checks.
Yeah, but the student themselves will not be receiving a check.
That's correct. Yeah. That's correct. Yep.
All right. Let's go back to, so we're at time. We could continue on and just answer a few questions. Aaron, I don't know if you've seen some repeat questions that you want to fire out. I can go through and look at a few as well.
Really quickly, I think really quickly, guys, let's thank everyone for joining.
Yes.
Yes.
We did hit our 60 minutes really fast. I was thinking maybe we needed to go 90, but obviously the world still goes on. So please keep joining us. I blocked out my morning to chat about this as best as we can, and there's been such awesome questions coming through that will hopefully, we really apologize. I mean, there are 100 and some questions right now, I think, on just one of my Q&A slides. So I've got two of them up,
The chat box is full too. So.
Yeah. Yeah. So we'll look to answer those and try to push out answers. I can recognize some of these people too. I'll try to reach out directly too. So yeah, Aaron, did you have what else did you want to talk about?
Just that, so as we've been talking, I've been going through the Q&A and trying to type out responses. So if you sent a question in, I've been trying to go through there and send out some text responses. There has been a lot of questions about either self-employed or independent contractors. And I think, Tony, can you expand on the PPP for independent contractors? They can't necessarily be included in the calculation because they should be going out and applying for one of the things on their own. Is that correct?
Yeah. So really, if we go back and what is the purpose of the PPP? The PPP is to make your employees receive a paycheck. Okay. And then there are also some provisions for to pay some business costs. So independent contractors are technically not your employee as a business owner. And that independent contractor has the ability to access their own PPP loan to bring income, to continue getting an income stream to them as an individual. So that's why payments to independent contractors from a business are not included in the calculation of your PPP loan, and they are not a covered cost. So I've seen several come in talking about, some people also concerned that my workforce is smaller now. And is the PPP loan just not applicable to me anymore? That's not necessarily the case. So you are still eligible to apply for the PPP loan, but if your workforce is smaller by design or by need, the ability for you to have 100% of that loan forgiven is the ultimate impact. So you may get a loan for $50,000. Let's say you've got a reduction down to $40,000 that's forgivable. At the end of this, you may have a $10,000 loan to your bank that would be payable over 2 years at 1% interest. So just because your workforce is smaller doesn't mean that this doesn't apply to you.
An EIDL question, Tony, as a landlord. This is a good question. I think I think this will be applicable. My impact will be the loss of rents, and it's unknown at this time. I don't think people have not paid yet, or if they have, it's right about now. So will the EIDL be available in the future, or do I have to get this done now? This is a program I think that's been in play for a long time. Actually, yeah. It's just now surfacing. So maybe just talk about that.
So the EIDL is a very established program with the SBA, Emergency Disaster Relief Loan Program. The expansion of the eligibility, I believe, cuts off at June 30th. So yes, the EIDL is available in the future, but the ability to access it may be limited after June 30th. So. And also that, I don't want to have a rush on banks, but the funding is finite under the act. Okay. So.
Yeah. I mean, it does say it's on a first come, first served basis. I think that's been kind of people read that and they put it down and call their banker and accountant and say, hey, what do I need to do? So.
Yeah. And there's nothing that says that you can't go through an EIDL loan process, determine as best you can what your needs are going to be, and then if your needs are different, you can pay the loan off. So as long as you're disciplined with the use of those proceeds.
And is the EIDL forgivable?
No. The only piece of the EIDL that is forgivable is that $10,000 emergency grant. If you check the box, which everyone should be checking the box to get that $10,000 advance.
Yeah.
That's the only portion that's forgivable. If you roll your EIDL into your PPP, that's not going to increase the amount that's available for forgiveness. That EIDL is going to be payable at the end of June 30, and then the 6-month forgiveness or waiver period. So beginning 2021, you're going to have to pay that EIDL back.
Can people just go after the 10 and just, I don't know. I'm getting that question a lot. Everyone says there's $10,000 out there waiting for me, Jake. How do I get it? How do I get it? So is it fishy to just apply for the 10, or are the banker? I'm assuming there's someone vetting that out, right? Aren't the bankers? We need to have a banker on this panel. And direct all those questions to them, right?
Yeah.
Do you know?
I've heard.
I just don't know that.
Yeah.
So
A couple of different trains of thought is, some people say, well, I don't need it, so I shouldn't apply for it. Other people say, well, the government is restricting my ability to work, so this is them buying the right to restrict my ability to work. So as a business owner, you should access it. Depends on where you fall in that camp. But obviously the EIDL is needs-based. That's going to be the determining factor of what the size of the loan is. So.
Hey, Tony, could you talk about, we've had a lot of questions about related entities in regards to the lease payments or rent payments and how that would affect the either the PPP or, what that self-rental entity could do?
Sure. So in both the PPP and the EIDL, they set aside the affiliation rules. So the affiliation rules don't apply. So you can have, let's take the example of a partnership that has an S corporation that holds the real property. The partnership rents from the S corporation. They're definitely related, owned by the same people. As long as there's an appropriate lease agreement between the two, rents paid to those entities would be allowable costs under the loans.
And with just kind of a general comment to those who are still with us, if you throw your question in again, well, maybe tell me, maybe this is a bad idea, because I was just going to hit a question that just came in because I know he's probably still hanging out with us to answer it. So if someone else is here, the question might have got buried in our list. So I don't know if we want to duplicate any questions, but someone just asked if we close down, this is in regards to the credit, the employer retention tax credit. If we close down in mid-March, but did not see a reduction below 80% in Q1, but did see a reduction in Q2, does that mean we are not eligible at all for Q2 and beyond since we were above the 80% in Q1? No. So it's the 50. So first off, we need to make sure you remember it's below 50% that triggers it. So you have to see your sales compared to the prior year in that quarter cut by half. So in my example, it went to like 46% in Q1. So if you stayed at anything above 50% in Q1, you're not eligible for that quarter. But then in Q2, if you see the dip and you go below 50, you trigger, you qualify, and now you get that credit until you bounce back above 80. So if you go below 50 in Q2 and stay below 80 in Q3 and Q4 compared to the previous year's quarters, you would get the credit for the rest of the way, Q2, 3, and 4. So you don't have to it doesn't have to trigger in Q1. It just you need to hit that 50. You need to go below 50 at some point. And that one, I'd rather just be affected by some sort of an order from the governor. Hopefully that can trigger, but if not, then you got to go to that test.
I'm going to jump in and touch base on another independent contractor question. I've seen it in a couple of places here where they're asking about net versus gross on the PPP. So the question that I've seen in a couple of places is, would 100% of my proceeds be forgivable? And again, as the independent contractor, self-employed, they're trying to get to net compensation to that contractor. So let's say your net income for a year is $100,000. You're right at the cap. You're going to be down to 2.5 times that. So on a, average that out. So what your allowable borrowing is going to be 1/12 of that times 2.5, and that's going to be the amount that's available for forgiveness. So that's going to be substantiated based on what your profit is, net profit. So it's not going to be your gross, 100% of what you bring in.
So Tony, that'll apply to Lance, who asked the question. It'll be applicable to them, but then can Lance apply for the PPP or SBA? I guess let's clarify those terms.
Sure. So both the PPP and the EIDL are backed by the SBA. The PPP is a program run by the SBA, but you must go through your local banker to obtain it. The EIDL is directly through the SBA. You can also get an EIDL through your local banker. However, based on probably the impact that they're seeing on getting these PPP loans out, you're best to go directly through the SBA.
And the PPP only applies to 501c3s. To reiterate that, I think several questions came in on that.
Yep. No C4, no C6, no C5.
There was a C19 that is available. That was like for a tribal organization.
That's a qualified veterans organization. It's
right.
C19, and a C19 is eligible to apply for the PPP.
So 3 and 19.
Yep.
But I've got kind of some feelers out there in the I think it's the C6 world. They're looking at making that reverse. I think a lot of them are, and there's
Sure.
a lot of special interest groups.
And they can access the EIDL.
Okay.
So your C4, C5, C6, your other nonprofit organizations, they can access the EIDL. Just currently, they're not eligible to access the PPP.
One other question is that I see a lot wait, you may have just answered this about full-time equivalents.
No, talk about that again, Aaron. I've seen that too.
Well, so Tony, correct me if I'm wrong, but we haven't received any concrete guidance on the initial count of what your full-time and full-time equivalence is, like what date that is. Is it at the end of 19? Is it at the origination of the loan? I haven't seen anything concrete. Have you?
Well, it's not authoritative, but the Treasury has put out the borrower guidelines and the lender guidelines, and both of those call for the 1-year period preceding the loan. However, in just discussions with banks, what they're asking for to put on the application, because the application just asks for your wages up there.
Yeah.
And then they're going to calculate what your loan's available. They're defaulting back to an IRS document, which would be the W-3 backed by the W-2s. So a lot of them are going to the calendar in practice. But the language stipulates the 1-year period preceding the date of the loan.
So then maybe average the average number of FTEs.
Yeah.
For 19.
Oh yeah, absolutely. So you're looking at, yeah.
Okay.
Yeah.
Aaron, is there any
some follow-up questions about that regarding if you've already decreased your workforce?
Yes.
Like from 2019 to 2020, you decreased it due to a change in maybe revenue streams, so you don't need as many employees. It sounds like if they're going off the average of 20 or the average of to the 2019 months, then that may affect the forgiveness or the forgiveness or the retention or the other.
Yeah. So there are two tests, and one is based on FTEs and the other is dollar value paid to employees. So the dollar value paid to employees has to be more than a 25% reduction. So even if you've got a slight reduction in your workforce, you still may be eligible for 100% forgiveness as long as you don't have a greater than 25%. So it's listed as either or, but what I'm not positive on is if it's the more conservative of the two. So,
Right. That's how I interpret it as well.
yeah, if you meet one or the other, you can get 100% forgiveness. I don't know that. Or if one or the other indicates that you should have a portion not forgiven, I don't know that answer. But
I mean,
but
if we think about it logically, which is always dangerous to do, if I've got 10 more people that I had in prior year and I'm doing my calculation, I'm going to get a bigger loan. In theory, my loan is going to be larger. So I think if you then don't use all of those funds on your staff, then you've got extra money, which should not be forgiven, but then there's the piece of you can use it on rent, interest, utilities. And so that's where you're making a point, Tony. As long as you keep a 75-25 ratio, or interpreting it as that will be okay. I think the big thing is to make sure that you don't go from 100 people to 20 and you get all this extra money, and what are you using it on? You won't get the relief that way. So
yeah, and if you go outside the allowable uses, now you're going to have recourse debt, and there could be some implications there if you're not using it for the approved purpose. So.
Right. In which case, it's a loan. You got to pay it back. Can we, while we're talking about that, can you reiterate from the day we get the loan? I know Aaron might be able to get this. The day we get the loan, the PPP loan, let's say, maybe or Tony, the day we get that loan, what are the terms on that loan? So I don't have to start paying on it just yet, right?
Correct. So the terms of the loan are 2 years, 1%, automatic 6-month deferral. Interest continues to accrue from the date of the loan, which they say is, they're saying that's pretty reasonable based on the 1% interest. So you get the loan tomorrow, your interest is going to start to accrue, but you don't have to make payments for 6 months.
And that interest, assuming you do all your qualifying and you get the loan forgiveness provision, that interest as well will be forgiven, correct?
Correct. Yep.
Yeah. Good. The question that was asked to me earlier, I interpreted the cash versus accrual question was applicable to the wages paid, but they were actually asking for the sales that were being incurred. And so I would say, because you're looking at prior year, I think you have to go off of your accrual. You need to go off the method of accounting that you are using for that.
So if you're a cash basis taxpayer, it would be cash basis. If you're an accrual basis, it would be accrual basis. Yeah.
Yep.
That makes sense to me.
Definitely. Sorry for the confusion there.
So there was a question on the date of the PPP loan. Will it be dated the date it is funded or on February 15th? So let me clarify on that. So the loan will be dated the date that it is closed, but the proceeds are eligible to pay costs dating back to February 15th. So if you've got unpaid interest, if you've got unpaid utilities, if you've got unpaid rent, you can apply the proceeds from the PPP and reach back to those costs back to February 15th and any payroll costs going forward. But the loan itself would be dated the date that you sign at the bank. The 2 years on the PPP loan, does it start after the 6 months or when it's funded? And actually, I don't believe that loan is actually, I think the date of the loan when it starts accruing interest is June 30th. So after that initial 8-week period. So once the amount of the loan is determined at June 30th and forgiveness is calculated, I believe the date of the loan is going to be June 30th and interest would accrue from that date forward. The date of the loan is still going to be the date that you write it. Interest starts on June 30th or July 1.
So someone asked, they're a small business, they're a small LLC, so I'm assuming they're a disregarded LLC, so they're probably filing a Schedule C. They understand the PPP is for employees, but for the owner, what can be done there? Can't apply for sole proprietor due to having employees. I I don't know if, I think in general, the understanding would be is, and Tony, you talked about this, is that for someone like that, I guess technically they're self-employed, so they're a Schedule C filer. Their loan, they can apply for to the PPP. That loan's not quite ready yet, correct?
Correct.
Can't be applied for yet, but they would qualify. Those people could have employees, so not only would they be looking at PPP help. That's actually a good question. Would they, a self-employed, would they still have to wait for this?
If you've got employees, you're allowed, if you're a small business with employees, you are allowed to apply April 3rd.
So just as if they were an S Corp because they have employees.
Correct. Yep. If you've got wages that you can substantiate on the application, you're allowed to apply.
Great. The component for their wage, though, because they are a Schedule C filer, must wait.
Correct. That would be outside. So they'd be looking at,
Is that a second loan, which you're not allowed to do?
No, you're not allowed to do. So, so they could try and go through and wait for the provisions for the self-employed and see if that's going to grant them more available borrowing under the PPP and go that route.
Mm-hmm.
But if they have employees, maybe they only got one employee and they don't pay them that much, they might want to wait and try and do the self-employed provision.
Right.
So, yeah, that's a great question.
Probably talk. Yeah, I mean, I hate to push it to the banker, but I mean, I wonder if they're able to do it in conjunction. I would think that maybe they would qualify to do it. Maybe, I'm not sure.
Well, I think allowable costs under that would be payroll costs. So they could use their proceeds to continue to pay their employee. But I don't believe, we'll have to wait and see the borrower guidelines and what the calculation includes. But what I understand is it's going to be net earnings from self-employment. So if the net earnings from self-employment are at $100,000 a year, but they're only paying employees, say $50,000 a year, obviously they're going to want to choose to go the route of net earnings from self-employment and wait till the second date to maximize their access to the PPP funding.
Aaron, do you see the unemployment question? $600.
Which one?
Which one? Is the unemployment $600? That's a Fed amount. Is that in addition to the state amount?
It is. Yes. That $600 is in addition to whatever they receive from the state. And like I said, the state can either pay it out in a separate check or they can combine it with their regular weekly check. But it is in addition to that. That's why there's been some concern regarding the amounts that employees are now going to get from unemployment, because that could potentially push them above what they would normally be making. So there is some concern there that it may encourage more people to claim UI. There is only it's a given time frame though that it covers. So, but yes, it is an addition, and I have it on my list to look about the prorating, if it prorates for employees that were just a part-time employee before.
All right. Well, we are approaching 10:30. We do appreciate all the questions and everybody who stayed on. We still got quite a few participants that are on, hanging around for the discussion. We do appreciate it. We're going to capture all of these questions, a lot of great questions that we haven't answered yet. And we're going to try and push those questions out on our website. We'll kind of synthesize a lot of these questions and get some answers going. So please check back on our website. We'll post that in our e-newsletter as well when that's available. We will be making a recording of this available at least the first hour for sure. We'll kind of have to just see how that renders out. So the first hour for sure will be available on a replay, also accessible, probably a link in our e-newsletter, and then that would launch from our website in that news area. So Thank you to the other panelists, and thank you to all the attendees. And stay safe and healthy out there.
Thanks, everyone.
Thanks, everyone.
Thanks for joining us.